What if I told you that China's debt is 3 times worse than America's, and it's hiding in plain sight? The world has been watching America's national debt balloon for years. We've all heard about how much the US owes, especially with interest payments eating away at the budget. But the real surprise lies in China's financial system. Behind the curtain, the numbers are far more terrifying. In fact, China's debt is not just high, it's out of control, and it might already be too late to stop the crisis. For years, the United States has garnered attention for its astronomical debt. The figures are staggering, close to $30 trillion, and it's no secret that the US faces a future where taxes will rise or inflation will take off in order to manage this massive liability. While China's debt often seems more contained on the surface, a deeper look reveals that their financial situation is more precarious than the US. But how bad is it, really? The numbers tell a shocking story. China's total debt might actually be more than 3 times higher than America's. And what's worse, the way China hides its debts could make its eventual reckoning much worse than anything the US is facing. At first glance, China's official government debt seems fairly manageable. It sits at around 84% of its GDP, a much lower figure compared to the US at 123%, and Japan at a staggering 250%. With these numbers in mind, China appears to be a more disciplined borrower, keeping its debt under control. But there's more to the story than these surface-level statistics. The reality of China's debt is far more complex and dangerous, and it's this complexity that makes it such a ticking time bomb. The United States is a unique case in the global economy, mainly due to its role as the issuer of the world's reserve currency. This gives it significant leeway to run large deficits without facing immediate financial repercussions. The US can accumulate debt and finance it at lower interest rates, largely because of the demand for its currency globally. But China doesn't have the same advantage. So how does it keep borrowing without facing a crisis? The answer lies in its highly opaque financial system, where debt is not just centralized, but spread across a complex network of entities, both public and private. Unlike the US, where federal government debt is the main concern, China's debt is split across local governments, state-owned enterprises (SOEs), and special entities that keep borrowing off the official records. Local governments, for example, have substantial leeway to borrow for infrastructure and other large-scale projects. In fact, provincial and municipal governments in China are estimated to hold over $12 trillion in debt, which is about 76% of the country's GDP. This debt alone pushes China's total government debt to approximately 160% of its GDP, a figure already much higher than the US now. Keep in mind that this doesn't even take into account the massive debt held by China's state-owned enterprises. When we add in state-owned enterprises, the debt picture becomes even more concerning. These SOEs borrow enormous sums of money, often to fund projects that serve the government's strategic interests. The China State Construction Engineering Corporation, for instance, is involved in multi-billion-dollar construction projects around the world, funded by debt. These companies are technically private, but they are heavily controlled by the state, making their debt obligations a risk to the entire economy. Investigations have found that these SOEs owe around $30 trillion, bringing China's total debt to a staggering 300% of GDP, far higher than the US. But there's an even bigger issue. China's official GDP figures are likely inflated. Independent researchers believe that China's real GDP could be 20% to 60% smaller than what is officially reported. If these figures are accurate, it means China's debt burden could be as high as 450% of its GDP, making the situation even more dire than previously thought. Despite this, China continues to borrow at remarkably low interest rates. The yield on Chinese government bonds is just 1.7%, nearly half of what the US pays on its bonds. How is this possible? The answer lies in China's capital controls. The government restricts the flow of money out of the country, preventing investors from diversifying into safer, higher-yielding assets. This keeps demand for Chinese bonds high and allows the government to borrow at low rates. But this system relies on China's tight control over its financial system, which won't last forever. China's low interest rates also stem from a lack of attractive investment alternatives. The Chinese stock market, despite being one of the largest in the world, has not performed well. Since 2000, the Chinese stock market has barely doubled in value, while the US market has tripled. In the last decade, China's stock market has actually declined, while the US market surged. This lack of investment options means Chinese investors are more likely to buy government bonds, keeping borrowing costs low for the Chinese government. However, the real danger lies in China's real estate market. The country's property sector is now the largest asset class in the world. With home prices in cities like Beijing soaring to 35 times the average salary, real estate has become the go-to investment for both the Chinese government and its citizens. But this housing bubble is unsustainable. If the market crashes, millions of Chinese citizens who have mortgaged their homes could face financial ruin, and the government will be forced to intervene to prevent a full-blown collapse. The real estate sector has created a cycle of high debt and over-leveraged consumers. For many, property is the only asset they can afford. But this has led to massive household debt. As prices continue to rise, fewer people can afford to buy homes, and defaults on loans could spike. If the housing market falters, China's entire financial system could unravel, triggering a recession that could affect the global economy. Adding to this pressure is China's ongoing battle with deflation. Unlike the US, where inflation has been a persistent problem, China has struggled with low consumer demand for years. This underconsumption is one of the key factors contributing to the country's economic stagnation. While the US economy is driven by consumer spending, which accounts for about 68% of GDP, China's consumer spending is only around 39%. This low consumption rate is largely due to a culture of saving, with many Chinese citizens focusing on purchasing property rather than spending on goods and services. This deflationary environment reduces the incentive to invest in the economy. Without strong demand for goods and services, businesses have little incentive to expand or innovate. While the Chinese government has been trying to stimulate domestic spending, it's been hampered by the massive debt tied up in the real estate sector. So, what does this all mean for you? China's debt problem is a ticking time bomb, and we could all feel the effects if it explodes. Whether through economic instability, a collapse in global trade, or financial contagion, the repercussions of China's debt crisis could impact every corner of the world. We have to be prepared for the possibility that the world's second largest economy may not be able to escape the consequences of its massive borrowing. What do you think? Can China manage its debt, or is a financial crisis inevitable? Let us know your thoughts in the comments, and don't forget to like and subscribe for more in-depth analysis of global economic trends.